Hello, and welcome to Afternoons with Aces, Episode 1, Chart of Accounts Design. My name is Kelly Fitzpatrick, and I am Consulting Sales Manager for Creel Consulting, a wholly owned subsidiary of SMX. I will be moderating today's conversation discussing Chart of Accounts. Joining me today, we have Oracle Applications Aces, Lee Briggs and Thomas Simkis, also from Creel. This webinar is the first in our series, Afternoons with Aces. All attendees are currently placed in listen-only mode and will remain that way throughout the session. There's a chat feature on the Zoom console on your screen. If at any time during that session you have a question, you can place it in the chat box and use the raise your hand feature to alert me to that question. I will transmit that question to Tom and Lee at the appropriate time so they may respond. If your question is not addressed live today, they will follow up with you via email after the session. And with that, I will hand it off to them. Thank you.
Good afternoon, good morning, or good evening, depending on where in the world you are watching. And welcome back to Afternoons with Aces, presented by Tom Simkis and Lee Briggs. This is our first of several sessions that we're going to be giving over the coming weeks and months throughout 2024 in our cloud reporting series. This is the first time we've given a session in a few months, so we're happy to be back with you. Little agenda we're going to go through. So we're going to cover introductions. We'll talk a little bit about Lee and myself. We have some best practices we're going to go over from an Oracle point of view. So Lee and I are Oracle Applications Aces, as Kelly said. So we're going to talk about chart of accounts practices really from that mindset. We'll talk a little bit about what a thick ledger versus a thin ledger means. Lee and I have been doing this combined experience for over 40 years. I've designed a number of charts of accounts. It's probably well over 100 between the two of us. So we have done this quite a bit. We do have a slant, as I said, towards Oracle. But some of the things we'll have in here, sort of chart of accounts, naming do's and don'ts, and some additional best practices really should be applicable no matter what application you are running. All right, so introductions. Lee, you want to go first?
Absolutely. Thank you, Tom. Good morning, good afternoon, good evening to everyone. My name is Lee Briggs. I am the Cloud ERP Team Director at Creel, now an SMX company. I've been with Creel for about 7 years now. I do have my degree. I got my accounting and finance degree from the University of Leicester. I got my master's from the University of Northampton. As Tom and Kelly did mention, I am an Oracle ACE. I got my ACEness in 2013. I'm also Staff Presenter of the Year from the Oracle Applications and Technologies User Group. I got that in 2014, the first year they gave that award. Tom, how about you?
Okay, thank you, Lee. So I'm Tom Simkis. I'm a JD and a CPA, so I got my Juris Doctorate from Temple University in 2002, and I got my Bachelor's of Arts in Economics and Business Administration from Ursinus College all the way back in 1995. I'm currently the Commercial and SLED Practice Director for Creel Consulting, an SMX company. I've been here since 2017 and am currently still here as of January 2024. I'm also an Oracle ACE in our little community that Lee and I kind of float about in. I am known as the second ACE because I got mine 1 year after Lee got his. And I was also fortunate enough to be an OATUG Star Presenter of the Year. I got mine in 2017. Also after Lee got his. All right, so we're going to talk a little about chart of accounts today. I'm going to hand it over to Lee to talk about some chart of accounts best practices and things you want to consider from an Oracle point of view. Lee, you want to take it away?
Absolutely. Thank you, Tom. So the graphic that we have here is a graphic we actually stole from Oracle. So I'm not going to take credit for the look and feel of this. So let's start off with what do we mean by a chart of accounts? So chart of accounts really looks at describing the number of segments you have to record accounting information and the attributes of those segments. So it controls the order of the segments, the width of the segment. So the order starts with company, location, cost center, natural account, intercompany, whatever order we have out there. The width of the segments, company is always 100, it is 3 characters long, cost center is 4 characters long, something like that. It looks at prompt. What do I call it? Is it company? Is it fund? Is it legal entity? Is it entity? Whatever it is, we're looking to call it that. One of the other parts that we have within a chart of accounts is a segment label. So what does this account do? And this is a Oracle terminology. So a segment label is something like, this segment is a balancing segment. Whatever journal I put in, however my structure is, it has to balance by a primary balancing segment. You have to have one in your chart of accounts. There is no choice about it. The second required segment you have is a natural account. That's where you're really talking about, this is cash, this is revenue, it's it's an expense, it is liability, something like that. The third segment that we talk about a lot is the cost center. That is in EBS, it used to be a required segment. In cloud, it is not required unless you're doing expenses, unless you're doing fixed assets. It is a segment that's actually called out there. And it also will help you if you're doing approvals by something like a department. If you're looking to use HR, you have something like a department in HR. Cost center is typically related to that department structure out there. So within our structure, we have a chart of account structure and an instance. The structure truly defines what the segments are. It also defines if you have security on there, if you're allowing security on those different segments. And we also look at cross-validation rules at that structure level. You get down to the structure instance, and the instance starts saying what value sets you're putting on there. So the structure will say the first segment is company, second segment is cost center, third segment is natural account. The instance will say, and this is the value set that I'm going to use in this particular case for company. So I may have a UK chart of accounts instance where I have company and it's going to be two characters, and these two characters mean something. In the US version, I could have the same structure instance, still using the same structure, so company is still first, but maybe I have a different value set because I have a lot more companies out there. That's a flexibility you're looking at for those. So within the structure, you have your segments, you have your rules. Within your chart of accounts instance, you have your value sets. That's where you also have your values. That's where you also control your combinations. As we said, we have 3 segments out there. You're going to have balancing, you're going to have cost center, natural account. The other segment that we use, we actually talk about in a little bit, is an intercompany segment. It's a segment that Tom and I pretty much have on every one of our implementations. That really allows you to start controlling the other side of an entry if you're going across balancing segments. So a journal between 10 and 20, you could have natural accounts and start defining all natural accounts. A bunch of natural accounts for due to 10, due to 20, due to 30, due from 10, 20, 30, or you can have that intercompany segment out there. Tom, is there anything you want to throw in on that slide?
Not on this one, Lee. We're going to cover general structure next and talk about some naming conventions and just some things that you and I consider. So we will go to that slide and talk a little bit about that. So chart of accounts generally consists of value sets and value set values, as Lee kind of said. So value sets, these are the containers that determine your format and length. So the value set will say it's 10 characters long or 12 characters long. And is it a character only, is it numeric only, or is it varchar? And then the value set values are the actual members. So as you see on the example here, we got a value set of XXX, GL_COA, and then we've got the rest of it. That's the value set. And then we've got the values. So value 100 in this example represents the US legal entity, and value 010. And just as a side note, I personally hate leading zeros. It is one of the things that bugs me most. But I'll say this, it bugged me a lot more in EBS than it does in cloud. And just as the reason for that is because in EBS, the ability to get information out was a little bit more limited. In cloud, you can do an export, and we do an export. Most of the time, the exports to Excel are smart enough to know that it's text value, so it's not as big of a deal as it used to be, but I generally just don't like leading zeros. So when you're designing your chart of accounts, I generally recommend that you start with your reporting requirements. Okay, so when I say reporting requirements, I mean your general ledger reporting requirements, your financial reporting requirements. So as an old Oracle wise man once said, if you need a financial report, and when I mean a financial report, I mean the P&L, a balance sheet, potentially statement of cash flows. By it, whatever it is, project, location, product line, line of business, then it must be in your chart of accounts. Okay. And don't let anybody tell you different. So, the example I use quite a bit, and I've got it in here, is project. If you need a P&L by project, and I don't mean a statement of revenues expenses, you can get that right out of projects, not a problem. I mean a true P&L with fully allocated costs all the way down to EBITDA. There's a tool for that, and that tool is the Financial Reporting Studio and the Financial Reporting Center. Lee and I are going to talk about that in a few presentations from now. But that information should come from your general ledger balances cube, and it really should be in your chart of accounts. Now, something else here that I want to highlight, and this is it's a best practice, but it really is something that Lee and I have done over the years. I'm a big believer that you prefix your value sets with the company short name. So we got XXX here, right? So if your company name is ABC, that would say ABC. Why do we do that? Because any value set that you create, if you use that nomenclature, when you go to search for it, you can type in XXX or ABC, and they're all going to come up. It gives you a nice, clean way of saying, okay, what are my company's value sets and where can I get a clean export? And they're not mingled or commingled with the Oracle seeded ones. And it's really nice if you're running either the Oracle setup documentation or setup documentation that's generated by a third-party tool. Having that prefix can really limit the number of reports that come back. The other thing that Lee and I really like to do is generally, again, this is generally, there's certainly exceptions to every rule, but generally your value sets tend not to cross applications if you're doing your key flex fields. So the value sets you're going to use for general ledger, you're generally not going to use those for fixed assets or for inventory. So we like to prefix the module that you're using it for. So we've got XXX_GL. We also like to prefix what it's for. Okay, so this is for the chart of accounts. If you're having an application that has multiple key flex fields, and the best example that I can think of is fixed assets, you would have an XXX_FA, FA meaning fixed assets, and then major for your major category, and then XXX_FA_minor for your minor category. But you've also got location key flex fields in fixed assets. You've also got your key flex field. So having those flex fields determine what they are, it really makes your reporting and your analysis a lot easier. And the last thing we like to do is, if you're not going to have a global chart of accounts, and you should, it's a best practice, you certainly want a global chart of accounts, but if you're not going to have one, then prefix the country or area that you're using this value set for. Again, it makes your reporting and your analysis a lot easier. And then finally, you've got what it is. So company, cost center, product, whatever it is. I really do like clarity. Now, you've got the ability to put descriptions in these, and you can certainly be very descriptive in those areas. But having it in the name, we just really find that helps us out an awful lot, and it's really always served us well. To that end,
I'm sorry, Tom, if I can just jump in there though. So the module part in there, the key part I think of there is owning. What module owns this? So to Tom's point, you may not use a chart of accounts in fixed assets, but if you've got location in your chart, then you probably do. You use it in your GL, but as a location, physical location, as location in the location flex field, you might use the same value set. But it's still, who owns that? Who's responsible for maintaining that? Because you go through so much stuff with value sets around, you have to make sure a value is in the hierarchy, it's all used correctly in there. It's still GL that owns it. I need a new location. Go and speak to whoever does GL stuff to make sure that they get all their tasks down, they flatten the hierarchy and all that kind of stuff. But that is a key thing. Which module owns it? Who should you go and see to go and fix that? Sorry, Tom.
That's okay, Lee. So the next thing we're going to talk about is a thick ledger versus a thick ledger. And Lee's going to discuss, really the main differences. We'll opine a little bit on what our preference is, but there really isn't a right or wrong answer. It really is what your preference is and what you're trying to accomplish. So with that said, Lee, you want to take it away and talk a little bit about thick ledger versus thin ledger?
Absolutely. So those terms, if you haven't heard them before, they are pretty much standard terminology. So it really controls the amount of data that's populated or the analysis that you're doing in your general ledger. So I'm going to start with the thick ledger first. The thick ledger is typically lots of detail, lots of segments out there, tons of segment values. So you're doing all your true analysis in the GL. Typically, when you start going through a thick ledger, you're also posting in details. What do I mean by that? Let's take accounts payable. Accounts payable, I have one company value and I enter 100 invoices all to the same company. With a thick ledger, you would typically have 100 journal entries going over to your ledger on that specific date, every one of them hitting the accounts payable thing, and you can see that it is 100 entries out there. You'll probably have invoice number available for you to look at in the general ledger. You may have supplier number, all that kind of stuff would be available on the journal entry. So you do your analysis in the GL. Typically with this, you'll also have a frequent posting schedule. So you're firing stuff off, to transferring transactions to the GL on a much more timely manner. So maybe every hour, just firing it off to get all that entry into the GL. Now, so is there an issue with this? Issue is really a wrong term. It makes your reports a lot heavier because you've got all those journal entries out there, all those journal lines, any of your reporting you're looking to do, trying to drill down to what it is, you're going through a lot of data out there. Certainly if you're trying to do a summary, because you've got more transactions out there, you're going to have to really summarize this out there. It tends to be a more antiquated way of doing things within Oracle functionality, at least. Why do I say that? Well, with the thin ledger, where you're doing maybe you've got a smaller chart of accounts, you're doing everything in summary. You're looking at sending those same 100 AP invoices, sending one transaction or one journal line over, hitting accounts payable for the sum of it. I can still get back to all that transaction information. For the folks that we have online who are using Oracle right now, you know subledger accounting. You probably, if you're GL folks, you've probably been looking at account analysis report. But that's actually looking at the subledger transaction. So it's still looking in the same place. It's got all that source information, but it's keeping it all there. Your GL, it's got your balance out there. You have those 100 transactions coming through for $1 million. You've got $1 million. Your GL is completely right. Your accounting's right. But you're doing your analysis within either the subledger or subledger accounting. So fewer transactions going to go through here because you're sending it on a less regular basis, maybe on a daily basis, as opposed to maybe an hourly basis in the thick ledger. So you're looking at balances there, doing analysis elsewhere. So if you're looking at, if you've got a ton of transactions going through, and I know some of the folks are on the call, where you're looking at tens of thousands of transactions going through, thin ledger is probably a little bit easier for you to deal with if you're looking in the GL. You can still do all your analysis looking through subledger accounting, but your analysis in the GL is probably looking at balances. Thin ledger makes it a little bit easier for you. Tom, that was kind of a high level. Do you got anything to add to that?
I have a question, Lee. It's sort of related, but I'll answer it now. We got a question by somebody that really deals with ledgers. Do you recommend a global chart of accounts, and it's kind of worded badly. Essentially, I think what they're asking is do you recommend a global chart of accounts if you've got countries with statutory chart of accounts? And I'm going to give kind of a two-part answer to that. I still recommend a global chart of accounts, but what I prefer to do is if your statutory chart of accounts, and I'm going to use France, I use France an awful lot, but the France statutory chart of accounts tends to be a lot more detailed than most global chart of accounts that I've ever seen. So just by way of example, France has some really detailed account breakouts at SG&A. They got like, and I'm going to get this wrong, but they got like 20 different categories of office expenses. And you just generally don't have that level of detail, especially if you're dealing with a thin ledger. You won't have that level of detail. So what I recommend is whatever chart of accounts is more detailed. If you're going to use the primary and secondary ledger functionality within Oracle, whatever the more detailed chart of accounts is, that should be your primary ledger chart of accounts. So again, in my recommendation, my experience, if I got countries that are operating in France, I have the French statutory chart as my primary chart. And what that allows me to do is, first of all, the people in France are actually trained on that chart in college or in high school, and they know it. And so they know generally how to use it. And because it's so detailed, you can map it very easily using standard mapping rules to summary accounts in your global chart. And so, it really makes your reporting a lot easier, and you give people the flexibility of using a chart that they're familiar with, but you still have your global chart and your global standards. So,
I'm sorry, if I just jump on top of that. So it's one of the cool things. Remember a couple of slides back, Tom was talking through naming of value sets, and you have your company initials at the beginning, the module that owns it. You talked about country in there as well. That's the perfect example of country. I will have presumably two natural accounts. If I'm working in France, I have two sets of natural accounts. I want to know that I'm updating the US natural account as opposed to the French national account, which probably won't change that much since it's statutory and folks have been learning it forever. But it's that kind of concept. I know which one I want to change. Hey, go and add new rental expense account. I know where I'm adding it.
Okay, thanks, Lee. All right, so now we're going to go into some chart of accounts do's and don'ts. So we got a couple best practices here and a couple things that, again, that we've seen quite a bit in all our years doing about this. So we talked about this already, but it does bear repeating because it's something that we have found is so beneficial. Have that short name in the front along with the module and the reporting purpose. So there's some really cool functionality that you can have in cloud that's relatively new in EBS, eBusiness Suite, the legacy on-prem Oracle product. You could have what was called a dependent segment in your chart of accounts. Now, Oracle never recommended that you do it, but you could. And what a dependent segment allowed you to do, and they actually used to recommend that your major and minor categories were set up this way for fixed assets. If you had a major category of furniture and fixtures, you could have a minor category of table and chairs, and you could make it dependent such that if you selected furniture and fixtures as your major, you would only see in your listed values for minor table and chairs. So it kind of helped people enter data in, and it did streamline accounting. In cloud, the similar functionality for that is something called related segments. And if you've got a chart of accounts that's confusing, it really is a nice way to limit people's choices. Now, there's pluses to that. Again, limits choices, but the negative to that is you do have to maintain that. My preference is use cross-validation rules. So cross-validation rule, obviously you have your segments that are related, and you can prevent people from choosing the wrong value using a rule, and you just give them a message. And my belief is that if you train people, they might get it wrong a few times, but if you have a good message in your cross-validation rule, they're going to get it. Whereas if you have related segments, they can't make a mistake, and they won't get that message. But it really is a lot of maintenance, and I'm not sure. I have not used related segments in practicality. I've used them in demo environments and I've played with them, but I have not used them in reality. So I really don't like to give a strong recommendation on that. But if you're thinking about doing it, I would say try it out and see how you'll like the functionality. A couple other things to note: use characters for value sets rather than just numbers. I'm a big believer. Again, I actually was an accountant a million years ago, and I know I hate to have alphanumerics in my chart if I'm entering an invoice. I use this example a lot, but I did have a client a long time ago that had a chart of accounts that was 14 segments long, and 2 of the middle segments were 28 characters each alphanumeric. And they had intelligence in there, and the AP people hated it because when they're keying their invoices, they couldn't just use their 10 key. They had to use the alphanumerics in there. So I really like numbers only for my children, but I like alphas an awful lot for my parents, right? So you can prefix them with a Z or a P or whatever it happens to be. And again, that's something that Lee and I typically do. So in Oracle Cloud, you can have something called multiple hierarchies. That's a construct that came across in cloud when they introduced Essbase. But I will typically have a hierarchy for management reporting that can be different from my hierarchy for statutory reporting, or can be different from my hierarchy used for allocations. And if those parents are different, I will frequently prefix my parents with what it's used for. So again, using the example I just had, if I've got a hierarchy that is for allocations, I'll have my parents prefixed with A's so that I know that, hey, these are my allocation parents. And if I've got a hierarchy for GAAP reporting, I'll prefix it with a G. I like to take the question out of my charts of accounts. Generally speaking, I think you got to train users and you got to train them well. But the fact is, if you allow a user to make a mistake, they will make a mistake, right? So the more help you can give them, the better off it is. You want to allow for future growth. That's both in the value and the value set, right? So what I mean by that is we, meaning Lee and I, we really recommend future segments. We typically have 2 future use segments in our charts of accounts. I would tell you in my 20 years or so of doing this, and Lee's got 20, so it makes 40 together. But I have had most of my customers have not used both future segments. I would say better than 50% have used at least one. And I have one client that actually used both, and they used both within 2 years of starting their implementation. It wasn't my client. I didn't do the initial chart of accounts design, but the company that did really didn't allow them a lot of room for growth, and they ran out pretty quickly. The other thing allow for growth is in your segment lengths. You know, if you think you're not going to have a lot of companies, and we'll just use 2 segments for company alphanumeric, and you grow very quickly, you know, then you're going to be a situation where you're using alphas and numbers. And again, that kind of violates some things that I like to do. The last thing, before I get to the intercompany segment, really, I don't like a logic in my charts of accounts. I do have some logic. You know, logic tends to break down pretty quickly, right? So if you have prefixes or suffixes, and you know this means this, in my experience has been that logic breaks down much sooner than later, and it really causes you problems. That said, I do like some logic. So again, in my simple world, if I've got a 3-segment company structure, I tend to keep, you know, North America in the, you know, 100s and 200s, and I'll keep Central and South America in the 300s. And EMEA tends to be in the 4s, 5s, and 6s, and then APAC tend to be in the 7s and the 8s. And then I've got my eliminations or my statutory companies in the 9s. It just makes it easier. You know, if you've got more than a lot of companies, you know, maybe 3 segments won't work. Maybe it's got to be 4, but that is a logic I do like to have. And I also like to have some logic in my natural account segment. I am a firm believer that, you know, assets begin with a 1, liabilities begin with a 2, owner's equity is a 3, revenues a 4, etc. Now I know in the public sector, they don't follow that logic an awful lot. It's, you know, I know that there's required charts of accounts that people have to have, again, in the United States for public sector. The GFOA is the Government Financial Officers, Accounting Officers organization. It's a really good organization. They have a really good chart of accounts. If you're in the public sector and you're in the middle of a chart of accounts redesign, I would urge you to look at the GFOA's chart of accounts. They do a really nice job. It's out there, it's publicly available, and it's very clean, and it's very well done. I actually use that as the basis for most of my chart of accounts redesign when I do public sector. Some quick don'ts. Don't rely on related segments. As I said, I'm not a big fan of them. The functionality is out there. You should be aware of it. And if you're really concerned about it, the functionality is out there. And the other thing is don't put in too many segments. Now, obviously, if you want a thick ledger, and you want all your reporting from GL, you know, go ahead, have at it. You've got a 30 segment. But bear in mind, you know, this, you know, the legacy EPM guys, they get freaked out when they see all the default dimensions that get created in Oracle Cloud. You know, they like to keep their cubes very sparse, not dense. And the more segments you have, the more dense that cube's going to be. And you know, again, sooner rather than later, you're probably going to have some reporting slowdowns. All right, Lee, you want to talk about some do's and don'ts on value set values?
Absolutely. So we start, as Tom mentioned, we've talked through, we like all our value sets to be alphanumeric. We try to keep our accountants sitting on their 10 key because that's where they're happy. It's going to keep them nice and efficient. But from a hierarchy point of view, regardless of what I'm using the hierarchy for, typically a lot of that's drag and drop. So from a hierarchy point of view, or roll-ups, we start looking at using the alphanumerics over there. So the kind of example I have, and again, this is just grabbing something that makes sense, and I know the lengths don't work. For every segment I have out there, value T is always total. It's all companies, it's all funds, it's all natural accounts. It just makes sense that it's T. And that harkens back to EBS when you used to do summary accounts. Had to be called T. That's where T came from. After that, if I'm looking at natural account, I try and break things out like as I would have on my trial balance. So I'm going to have asset is going to be total assets. And maybe I'm going to have an L asset, long-term asset, C asset, current asset, something like that. Liabs, liabilities. Owner's equity, maybe equity. Rev, EXP, something like that. Just so it's something that's blindingly obvious as I'm looking at it, I know what it is. Again, I can always look at the description, but just as I start drilling through, I've got that kind of idea. We also try to follow a logical structure. Tom was had spoken a little bit about having logic in your chart, but not too much logic. sticking with the ones as an asset, twos liability, that kind of thing. It really helps you when you're building out your hierarchy, which we'll talk through later. Kind of gives you that logical structure as we go through there, both with the parents and with the children. The other cool thing that we can do in Cloud, you could do it in EBS as well, is put default values in for value set that folks shouldn't be touching. So we talked about having future segments out there. So for segments that I don't have a use for yet, but I'm building in that functionality for if we buy a chicken farm and we have to report for something around poultry, that we have a segment for it. Well, I'm never going to keep the key for that until I buy that chicken farm. So let me just default the value in there. Anyone who pops up that little popped up the window so they can see what the account values are, it'll just be populated automatically. Nice little functionality just to make your lives a little easier. The other thing that we're really cautious of with a value set, and this really is in the natural account, is making sure you get your account types in there. So making sure I get it is an asset, it is a liability, equity, revenue, expense. Again, you can change it later on, but you have to jump through some hoops to make sure that to change it. So it's trying to get that part right, getting your account type in there. So you have making sure that you have, yes, this is a cash account, this is accounts receivable. We know we've got all those really cool reconciliation tools in AP and AR to make sure everything ties. It actually looks at that account type out there. So making sure that one is populated. And then if you do any of the cool stuff with a reconciliation flag, so making sure when activity is going through there that I see a debit and credit go through and it's for the same amount for the same transaction, yes, it will go through there. So it's really cool functionality. Make yourself aware of it. So that if you have a use case, that's kind of the functionality you're looking for. Tom, actually, for the don'ts, Tom stole a lot of these. He's always stealing my thunder out there. So trying not to put too much. You're fine. Try not to put too much logic in there. Alphanumerics, keep your alphas for your parents, your numerics for your children. But the two bottom ones are the important ones. When we're in Cloud, you can't have duplicate descriptions anywhere. So it's trying to, going through, clearing all that kind of stuff up. I can't have two accounts called cash. Now, in my case, if it's that kind of thing, then maybe one account, I'll put the last 4 digits of the bank account number on there so you know what you're looking for. You're going to go through and go be really focused on, I can't have a duplicate description. I can put an S at the end of one of them. Typically, I'll put an S at the end of the child rather than the parent because I want my parent, which is going to be on my reports, to be correct. So it's that kind of thing. But going through and making sure you've got no duplicate value names. Oracle also does have words you can't use in descriptions. Kind of breaks a little bit of the space. Now this list is pretty static. The document that you have up there, and we will share this this PowerPoint as we go through. Or sorry, the recording of this will be published next couple of hours, I think. It actually has the full list of all the words that you can't use in there. Wow, it sounds like George Carlin out there. And it's, you can't use like ampersand out there. You can't use plus signs. You can't use slashes in your descriptions. For words, you can't use like average. You can't use and. Anything that's kind of techie, from an IT point of view, groups, that kind of thing, you can't use. Again, that list is pretty static, but Oracle does update your that documentation. And as you can see in the URL, just under descriptions, it is 24A. So that list is current.
Okay, thanks, Lee. All right. So a couple things about key flex field segments. And I did mention when I was speaking last that I would mention your company, and I'm going to mention it on this slide. So there are a couple key segments. As Lee said, you have to have a balancing segment. So in Oracle Cloud, you have the ability to balance by 3 segments. In EBS, I think it was only 1. I'm pretty sure Oracle got this multi-balancing functionality from PeopleSoft, among other things. But so if you need to have a balanced balance sheet by your balancing segment, obviously Oracle does that automatically. But if you also wanted it by cost center or product line, or again, some other segment, you are allowed to do that. I will tell you that just because you can do something doesn't mean you should. Make sure it is a hard and fast requirement. Why is that? Because if you have a long journal entry, and when I say long, 500 lines, Oracle obviously can handle many-to-many balancing. It does better with one-to-one, but it can handle many-to-many. But if you've got many-to-many, It does require what's called a clearing company. But even if you've got, one-to-one and you're balancing by cost center and you're balancing by product, 500 line journal entry can turn into a 1,500 line journal entry very, very quickly. If you've got a lot of things going on. So again, if it's a requirement, you can do it, but just, be cognizant of it. Cost centers, what is it? It really just facilitates grouping your natural accounts by a cost type, right? So if you've got departments, if you've got product lines, or if you got locations, the main thing I see cost center used for is location. It's somewhat redundant because especially the biggest reason people use it, what used to be for assets, but assets has a location segment, right? And it does a really good job of location reporting, and your location reporting should come from assets anyway. But as it says here, if you are doing assets and expenses, it's required. I also should note, and I'm going to get this wrong, but for the most part, I'm close enough to right. If you're doing HR, cost center almost has to be your department segment. So you have to have a department segment for HR. And I'm 95% sure it has to be your cost center in your chart of accounts.
So Tom, I will actually make that 100%. You are
Thank you, Lee.
correct. It has to be that. So something to bear in mind as you're going through this. If you are doing an ERP implementation and HR isn't involved, got to bear that in mind, because you can't obviously, if I've had clients to say, no, make it location, that location will be fine. Yeah, if you actually put in HR later on, they're going to be mad with you.
Yeah, it's a problem. That's 100% right, Lee. And then, same thing, if you're doing an implementation, we have a client that we're working with now in North Carolina, and we didn't do the initial setup. And, there's a couple things there that we were able to fix. We came in to help them out, but there's a couple things we couldn't fix because the prior SI didn't set things up in a way that, really was best practice. But, if you think, if you're only starting with ERP, just bear that in mind, that if you ever think you're going to use Oracle HR, you don't want to limit yourself. So, just be cognizant of that. The other nice thing is, again, if you're using Oracle Cloud Procurement, you can use Cost Center for business intelligence reporting, and you can also use it to route transactions. So it can make your approval rules a lot easier. You have to have that natural account type, and that just determines the type of account it is. Something to note here, and we will note it, but we're going to hit this pretty hard when we get into financial reporting in a couple months. When you're setting up your natural accounts, please, please, please make sure you set your qualifiers up. Those qualifiers allow you to do a lot of really cool things out of the box with reporting. Oracle will generate a P&L for you automatically, and we've got a session that's going to show you that in a few months. But if you have a consulting company that says, oh, we don't know how to do SmartView, we don't know how to do FRS, and there's a lot out there that don't, and you want to get a P&L, if you set those qualifiers up properly, there's actually a job that you can run that will generate a P&L for you automatically, and it will also create your account groups automatically. It also writes up some really nice infolets for you automatically if you set those qualifiers properly. And then lastly is the intercompany segment. I cannot stress this enough. Again, this is a strong belief that Lee and I have. We had it for a long time. You should always have an intercompany segment. And you might say, I've only got like 2 or 3 companies and I really need an intercompany segment. You still should. And the reason is that we recommend it is it really makes your intercompany rules so much easier to set up. Even if you've only got a few companies, you can create what's called a chart of accounts rule. And there's essentially 4 places or 4 levels you can create an intercompany balancing rules in Oracle if you're using intercompany, not intra-company. And if you're not sure the difference between the two of those, you can type inter and intra-company accounting in Google, and it'll bring you to a paper that Lee and I wrote probably 15 years ago on the difference. But at any rate, you can have a chart of accounts rule. You can have a ledger rule. You can have a primary segment value rule. And then you can have, I think, a balancing segment rule. But if it's pretty simple chart using a global chart, you can define your intercompany rules at the chart of accounts level, and you can just do one rule for other. And Oracle automatically knows when I see company 1 and company 2, it'll balance that journal entry and it'll put an intercompany account in there. And it'll have a balancing segment of company 1 due from company 2 and company 2 payable to company 1. So it really makes your intercompany rules a lot easier to create and certainly maintain. And that's really what we want. Lee and I frequently say with reporting, but it's true for intercompany rules and it's true for a lot of other things. When you set up an Oracle system, you're always going to have to maintain your chart of accounts. But if you set up your reporting and your chart of accounts right, you don't have to maintain your reports. You don't have to maintain your intercompany rules that much. If you do a bad job, you're maintaining all three. If you do a good job, at the most you're maintaining is one, and the other one should be taken care of by using proper hierarchies. So that's just a couple things about the key GL segments. Lee, you want to talk a little about S-based mapping? You were talking a little bit about this, about words you can't use and some things here. So we'll talk a little about the S-based mapping.
Absolutely. So when cloud was built, Oracle took their best of everything. That's where they started from. So most of financials came from EBS. We're good with that. The one thing that they didn't bring across for EBS was how Oracle keeps the GL balances. We do still have GL balances table. There is still a table out there, but all the other balances are kept in S-Base. S-Base we have an entire session for. I think that's February. It might be March's session. We do actually have all these mapped out, I promise. Just don't recall which session it is. With S-Base comes with its own functionality. So if you're EBS, some of this functionality is going to be a little bit different for you. But in S-Base, you have a bunch of dimensions out there. On the right-hand side, we have what the dimension is, what it's called, what you'll be able to see when you start using SmartView, when you start using FRS. On the left-hand side is really where it's coming from. So in S-Base, I can connect to different cubes. My cubes essentially relate to my chart of accounts. So if I've got one chart of accounts, from a GL point of view, I will have one cube. If I have multiple charts of accounts, I'll have cubes. I will have a separate cube for each of those, and I can choose which one I'm connecting to on analysis as I go through there. Within my chart, I will have my different segments. We talked that through earlier, I think on slide, I think 5, we were talking through all the segments we have out there. The segments relate to dimension names. So in S-Base, when I do SmartView, in SmartView or FRS, I'll be able to have all my segments out there. I can choose whether I pull them in and specify or expand one of those segments, or if I'm just taking the sum of them or something in my hierarchy in between, that would be my dimension name. Within my dimension name, I will have all the values available to me and the descriptions. So the values will be showing up in S-Base. They're actually called dimension member names. And the description would be an alias of that member. Now, we talked a little bit earlier about you can't have duplicate descriptions out there. This is why SmartView loves all these descriptions. It keeps all that information, actually keeps it in two separate columns. So you have your value, your name, and you have your description. That's why it has to be unique, so you know exactly what you're looking for if you're doing any of your analysis by the description. So it's kind of cool. Now, if you say, Lee, I can't do that, I'm going to have some dupes. Oracle Cloud will actually take care of that for you. Oracle will force duplication on you. Rather than just having your description of cash, Oracle will take your value and description and dump that in the description. So it won't be cash. You'll see the description as 1,000-cash. It's still forcing the uniqueness on there. From a reporting point of view, now you're just showing 1,000-cash as your description, and life is still golden. But the aim, everything we always aim for, is those unique descriptions out there. We've talked a little bit about hierarchies. When we get to S-Base, the terminology changes a little bit. So it goes from hierarchy and hierarchy versions to tree and tree versions. They are available to us within that dimension member name, within where I see my values. I'll actually see my values, and I'll see the hierarchy. I'll be able to expand out and move around in the hierarchy out there. So life is good there. Whether I have ledgers, I will have a ledger, but whether it's a primary ledger or a secondary ledger, it actually appears in the same field. It actually appears in my ledger dimension. Interestingly enough, if I do reporting currencies, it still shows up in the same area, still classed as a ledger. So I can see all that kind of information out there. Or if I even have a ledger set, so it's not just a single ledger, but I'm pulling together maybe a corporate ledger, and I have like an adjustment ledger or eliminations ledger, something like that. I can actually lump those together in a ledger set and just report off all three at the same time. It's all hiding there in the, will be shown there in the ledger dimension. The last couple we have out there, the accounting calendar, the concept from GL still holds true. I still have years. The year is made up of quarters. Quarters are made up of periods. Regardless if it's a 12, if you have 12 periods within 12 periods within adjusting, 12 periods adjusting, three periods and adjusting, or having like quarterly adjusting. That functionality still exists out there. That will all show up in the accounting period dimension. And the last one I think we have out there is the scenario name. So scenario is really you're looking at, am I talking about actuals? Am I talking about whatever I call a budget? Am I talking about whatever I have as a forecast? All that functionality is still available in GL. Now, if you're getting kind of super complicated and you want to do real budgeting and planning, EPM uses exactly the same functionality. Now, you can do a lot more on the EPM side, but from a reporting point of view, we can say, yes, I'm looking at actuals, I'm comparing those against budget or a forecast or whatever my scenario is. They would all appear in that scenario dimension. As I said, S-Space is its own thing. We do have a session coming up. I'm going to say it is March or April where we start going through that. That would be a really interesting session for you. As Tom said, some of the integration implementation partners we've seen don't often focus on SmartView FRS. It's one of the things that Tom and I have actually clung on to all the time because at the end of the day, you need to get reports out of your ERP system. Tom.
Okay, so I have next thing is questions. That is all we have. I've got one question that is, it's actually kind of related to a session we're gonna have in the future, but I'll sort of ask for it now. So the question, I want to kind of paraphrase this, but more or less they're saying that they were told by the systems integrator that Oracle doesn't have a P&L out of the box, and you're saying it does. Could you clarify? So sure. So if you just go into Oracle Cloud ERP, is there a report, called P&L that you can run? And the answer is no, there's not. But what you can do is, and again, we will cover this in a future segment, but what you can do is, again, if you set your chart of accounts up with the proper hierarchy, and by hierarchy, I mean, like the T, Lee kind of talked through, accounts, liabilities, revenue account, cost of sales, and also set up your proper account qualifiers, payables, receivables, and things. There's a job that you can run that will generate a few things for you. One, it'll generate an FRS report, Financial Reporting Studio report. It actually generates a couple for you. It generates a P&L for actual versus budget. It generates a trend P&L. It generates a trend trial balance. And that P&L is a really good looking report. And the really cool thing is actually when you're setting up your applications, if you use the Rapid Install Loader, which is a tool, an Excel tool that you can use to configure your chart of accounts, before you load that, Oracle gives you the ability to preview what that canned P&L is going to look like. And it will also give you an ability to preview what some of the canned infolets are going to look like before you actually configure the application. So it does a really nice job. So, if you run that ESS job, it does generate those reports for you. It also generates the account monitor groups for you so that you get some account monitors on your general ledger reporting homepage. As it also lights up some standard infolets. So if you want a little bit more detail about how that works, again, we've got a session coming up in, I think, 1 or 2 months. I apologize. As Lee said, I don't have all these memorized. We do have them all planned out, but
Tom,
I don't have
actually,
them all memorized.
Tom, that one for generating those standard reports is actually February 23rd.
Okay, great. All right, February 23rd. I don't see any additional questions right now, but what I will do is I'll give anybody another minute or two. If you're shy, please don't be. I'm not letting people's names out here. So if you're worried about answering a question, I will not mention your name. But if you do have any questions, now is your chance. And if you don't, that's perfectly fine. This was broadcast live on Facebook Live, so you'll be able to